if you are to be a successful limited partner investor and you're going to invest in syndications, the number one factor in your success is going to be if you're join a community.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larsen. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's podcast, we welcome back Jim Pfeifer. Jim has dedicated his career to helping educate and advise people on personal finance and investing. As a full-time passive investor, founder and former president of Left Field Investors, and now co-host of the Passive Pockets podcast, Jim is passionate about empowering investors with accessible education and community networking opportunities. He holds a degree in finance and marketing from the University of Oregon and a master's in business education from the Ohio State University. In his free time, Jim enjoys skiing, playing ultimate frisbee, and cheering on the Buckeyes. He lives in Columbus, Ohio, with his wife and children. Jim, welcome back to the podcast. As I was saying in the intro, you joined us on episode 121, and you're back with a little more hair on your head and your face this time, just like me. Yep. For episode, we're at 250. I'm really excited. This is a cool milestone for us.
Yeah, well, thanks for having me on, and congratulations. Yeah. For sure know how hard it is to be a consistent podcaster in 250 episodes. That is something else. So congratulations.
Yeah, no, thank you. And no, it's been awesome. We have a great community, and I'm excited for you to share a little bit about how you've grown your community with now Passive Pockets. Share a little bit, Jim, about where you came from Left Field Investors, and now you got Passive Pockets, and I'm really excited to see you guys grow your community as well.
Yeah, sure. Thanks. So Left Field Investors was it's funny. It's 5 years or almost that since we started. We were a pandemic baby. Yeah. We were supposed to be just a dinner club in Columbus, Ohio, where I live. Oh, wow. And March 18th, 2020 was our first meeting.
Really?
And yeah, and that meant that it got canceled, and we ended up going online to this brand new technology called Zoom that no one had ever heard of. Yeah. And so we went on Zoom, had a meeting of 10 or 12 people, and I was thinking of it as a mastermind. So I tried to keep it small. But the cool thing was, it was the pandemic, so no one had anything to do. So we were able to get some really cool speakers like Brian Burke right out of the gates to come to our little meeting of 20 people because no one had anything to do. And so it just kind of grew from there. By the end of the year, we had 50 members, and I kept trying to keep it small because I was thinking mastermind. And by that time, we realized that there was such a passion for people to learn about how to be a limited partner, how to be an LP in syndications, because there weren't a whole lot of groups there. And it's really scary to wire that amount of money to somebody you don't know. And so there's all kinds of really good reasons for a community. And so that's when we really said, okay, we're gonna do this thing. We got a website. We started our podcast, and we worked really hard for 4 years building this community. The culture of the community is the thing I'm most proud of, and that wasn't us, the founders. That was built by the members of the community. And the thing that is, like I said, it's difficult to be an LP, right? These are long-term investments. They're completely out of your control. And, it's hard to build trust. And so finding a community of other people who are doing the same thing, where you can share knowledge about operators, about markets, about asset classes, about all these things to help each other learn. And it's a group effort. And so we worked 4 years to build what, I think is a great community. And then we started talking with the folks in Bigger Pockets, and they were starting a community as well. They were interested because what they found out is, a lot of us started on Bigger Pockets. That's how I got my start in real estate, buying single family homes, then buying small multis, and then, being an active investor. And then the problem is, when I get older and I've done it for a while and I get tired of being an active investor, I find out that syndications are out there. Now I want to be passive. Well, then you can't really get anything from Bigger Pockets there. So there's a lot of people that kind of graduate from Bigger Pockets, and at Left Field Investors, we would say, come on over here. And now, in September of 2024, we merged with Bigger Pockets to create Passive Pockets, which is the same community of Left Field Investors. It's just we have the resources of Bigger Pockets to support more of the things that we want to do. And so the things we're doing and doing at Left Field as well is we allow LPs to connect with each other. We have a forum where you can chat and talk to each other and learn. And then we all connect operators to the LPs. So we
Yeah.
have deal flow that you can go and we do deal reviews. So we
Yeah.
have experienced LPs review in a webinar, interview and ask the tough questions of the operators, and then kind of after the operator gets off the call, then we kind of chat about it and say, would we invest? Would we not invest? And
Yeah.
it's a great way for LPs to learn. So there's a lot of resources on the platform. And the nice thing now is, at Left Field Investors, we were passionate about serving the LP, but we didn't have the resources to do all the things we wanted to do. And so now with this merger with Bigger Pockets, we remain have the same passion about helping the LP. And in fact, Scott Trench, the CEO of Bigger Pockets, might be the most passionate guy about defending the LP of anybody I've ever met. He's just all about it. And now we also have some resources so we can do more things, better things with a company like Bigger Pockets behind us. So that's kind of the 5-year story.
Yeah, that's awesome. Yeah, and bigger. I mean, a lot of listeners are familiar with Bigger Pockets, and yeah, I like how you differentiate that. It's like, hey, Bigger Pockets was built for the active investor, and with our coaching clients, we talk a lot about, hey, it's great to have an active strategy, but as you mentioned, at some point you typically graduate towards that passive strategy as you scale. Talk a little bit about your evolution, Jim. Like, what were you doing on the active side? And talk about your journey towards more of a passive investor.
Well, it's funny. I thought I was always a passive investor, right? So, when I got into real estate. So before real estate, I was always a stock guy. As soon as I graduated from college, I started my 401k. I was confident the way to build wealth was paper assets, and eventually I became a financial advisor. And the funny thing is, because they train you, I did this, 20 years after college, they train you like you don't know anything about money. And I was pretty sure I knew everything there was to know. And at the same time I was becoming a financial advisor, I was an accidental landlord because we couldn't sell a house, so we turned it into a rental when we moved, when our third child was born. So they were teaching me about money, and I was seeing money in action with real assets. Yeah. And I was applying everything I learned to real assets rather than these paper assets. And what I learned is that, to me, paper assets are speculation, because you're really buying something and you're holding it, hoping you can later sell it to somebody else for more, right? With very little current benefit in the form of distributions or cash flow. And I was learning that real assets that produce cash flow and income, that's investing to me, because you're receiving a current benefit, and then on the back end, you'll probably get appreciation, but that's not the full benefit. And so as I was learning, I realized this real estate stuff, that's kind of what I want to do. Yeah. And so I was a financial advisor for a while, but when I got to the point where I was investing more in real estate, because I always prided myself in putting my money where I put my clients' money, and I couldn't do that anymore because financial advisors, you're not licensed for it and you don't get compensated for it. So it's really hard to recommend real estate to people. Yeah. So I started getting more into real estate. I started buying single family homes. There was buying turnkey properties in Memphis and Indianapolis and Dayton, Ohio. And then I had some A-class kind of suburban rent in Columbus where I live. And I saw that they were, making money. And so I thought, okay, well, one door is great. Why don't I get more doors on property? So I started buying multifamily, and I was out looking for a fourplex, because that's where most people start. And I somehow ended up buying a 22 unit C-class property. And then
what year was that?
Oh man, that was like 2016 maybe.
Yeah. And that was a good value add, great time.
Oh yeah, it was that was the only thing that worked on these assets was that I got lucky with the timing. I bought a 22 and then an 8 and a 4 all back to back, and just kind of went all in. But the whole time, the problem was I was an active real estate investor, but I thought I was passive, right? Yeah. Because I had a property manager who managed it for me. Yeah. That does not make it passive, right? I was the asset manager, but so what I was doing mostly was I was fighting with my property manager because he wanted to evict people and do all this, and I bought it for cash flow. Right. And it wasn't cash flowing because we had to evict, we had to like redo everything, and I wasn't willing to do that. And my property manager was super
Yeah.
expensive at his at the property turns when we had to evict somebody. It just
Mm,
cost a lot of money, and I was trying to make that property cash flow, so it just didn't work. And slowly, I realized I just wasn't a good asset manager. And that
mm,
22 unit, that large property, I actually, when I sold it to a buddy of mine, knowing I had more than doubled the value just by owning it and having the market go up, right? That
mm.
saved me.
Yeah.
But I sold it to a buddy who I knew within a year he would double the value of that property, and he did.
Yeah.
But I just didn't have the patience or the ability to do what he did, which was basically evict all the bad tenants at once, put a bunch of money into it, and then, really drive the value. Because I didn't
Yeah.
understand that net operating income on commercial properties is what drives the value. I was still a single family
About that.
home guy. And so
Yeah.
I really didn't understand what I was doing, but I made a lot of money on all the properties. And
Yeah.
so what I realized around 2018, 19 is that I wasn't a good asset manager. These properties, other than the suburban ones, the original
Yeah.
ones I had, these weren't cash flowing properties. They
Mm,
were appreciating properties, but I was firing property managers. I was, fighting them constantly, getting new tenants. It just wasn't working out. It was
right.
because I wasn't a good asset manager. So then
Mm,
that's when I found syndications. And then I realized that's passive investing, right? That's where all the work is up front. I have to qualify the operator, make sure there's someone I want to operate with or deal
yeah.
with. Then I need to analyze the market, analyze the deal, send in my money, and I'm done, right? Then I'm just
Yep.
collecting reports and hopefully distribution. So
Yeah.
that's totally different from active, what I thought was passive was
Yeah.
not. So that's kind of my story. And once I found
Yeah.
syndications, I was like, okay, I can do this. This is where my strength lies. I can evaluate operators, analyze deals, but I don't have to operate and manage the asset. And once I
Yeah.
found syndications, that's when I kind of was off to the races. And the first thing I did was I need help. I want to learn from others, and that's how we started the community.
Yeah, that's awesome. And there's a lot of lessons in there, Jim.
Yeah.
My MBA's in portfolio management, and I went through a lot of the similar experience. I know we covered a little bit of this in our first podcast together, but I think it's something that's very interesting. A lot of people don't understand, and you said it. You as a financial advisor, with most companies, unless you're an RIA or with some of these companies that are set up more like a family office,
Yeah.
you can't sell away. You can't, not only can you not recommend these alternative investments to clients, but in most cases, you can't even invest yourself if you're working for one of these companies. Do you mind
Right.
sharing a little bit about that?
Yeah, that was one of the things that drove me crazy is I was trying
Yeah.
to do different investments and with
Yeah.
people, right, with other people, but you
Right.
can't when you have all these licenses. So eventually, I had to get rid
Yeah.
of all my licenses because it was stopping me from doing what I wanted to do. And the other thing
Yeah.
about financial advisors, they don't avoid real estate because they're like, evil geniuses that want all your money in paper assets, although they do, but
Yeah.
they're not licensed, they don't get paid. And so they
Yeah.
also, a lot of times, you're going to invest in real estate, you're going to take money out of their pocket,
Yeah.
but also they don't have the modeling, the software to include real estate.
Yeah.
So now my current financial advisor, he does include real estate. So one
Yeah.
of the biggest recommendations I have for people is if you are going to work with an attorney, a financial advisor,
Yeah.
a tax accountant, a CPA, which I recommend you work with those three professionals and don't do it
Absolutely.
yourself, make sure they invest in real estate. If you're a real
Absolutely.
estate investor, make sure
Absolutely.
that not only do they understand it, but they do it themselves.
Yeah.
Because, my financial advisor, he includes all my real estate, which is the bulk of my portfolio. He includes that in the financial modeling. When I send a K1 to my CPA, he understands because he deals with a ton of K1s because
Yeah.
he's an investor himself. And so those
Yeah.
kind of things, the same way I prepare my own tax documents or my tax returns. I don't prepare my own legal documents anymore. That's things I leave to the professionals, and I just make sure that they have real estate exposure in their own portfolio so they can, be experts
Yeah,
in what I do.
that's an excellent point that I think a lot of newer investors don't understand. If you need any of those professionals, as Jim was talking about, we have a great list inside of our community. Just shoot us an email at info at nextlevelincome.com, info at nextlevelincome.com if you need somebody that you want to work with that understands real estate. Because what we found, Jim, is that the ultra wealthy, those that are worth, I was just on a podcast yesterday and you're talking about how, the average investor, they're like, what's the model? Well, you can tell us better, 60/40 stocks and bonds or 80/20 stock if you're, more risk, tolerant, whereas you look at the ultra wealthy and they're putting maybe 20, 25, 30% in stocks. They have 25% in fixed income, 25% in real estate, 25% in other alternatives. And that's not what we hear from our advisors. And again, it's typically because they're not incentivized. They're not even in some cases allowed, nor do they understand how to model it and do that.
Right. Or they don't even know about it. And it's not malicious necessarily.
No.
But if you think about it, think about the wealthy people that you know or that you know about.
Yeah.
I can almost guarantee not one of them became wealthy from the stock market, right? They either own businesses like Warren Buffett or own real estate, right? Those are the two ways to grow your wealth.
Yeah.
And, throwing money in the stock market, the only use I see for the stock market for me personally, and everybody's different. But I use it for liquidity, right? Because it is, especially when, interest rates were really low, there was no other place where you could get liquidity with some return. So, that's my use for the stock market. Because when I first got into passive investing, I made liquidity errors, right? That's my biggest error. Because if you're an active investor and you own a 22-unit apartment or you own a single family home and you need money for anything, right? You can sell those. Now, you can sell them tomorrow. You won't get the price that you might want, but you could liquidate and get cash. But if you're in a syndication, you're stuck, right?
Yeah.
You cannot. And so when things happen, like when the market changes, so, in 2019 and 20, all the deals had a form of 5 years, but most of them were taking 2 or 3 years to fulfill their business plan. So investors got used to investing 50 grand and 2 or 3 years later getting 100 grand back, right? Yeah. And so when the market changed and interest rates went way up, then deals that were pro forma at 5, now they're like 7 or 10 years. So if you had planned your liquidity to be, rotating through every 3 years and now it's every 10, that's a big deal. And I didn't really, I kind of got caught flat footed with that. Like, liquidity, that's something I need to think about. That's different when you're passive as to when you're active. So that's one of the key lessons I learned is you got to make sure you have liquidity. And so now I put some of it in the stock market.
Yeah, that's a great point. And, you always have to look at these, if it's a syndication in real estate, you have to think of it like real estate. You probably can't sell it the next day. And if you're not the GP, if you're not the operator, you don't get to make that choice. And if you want to sell it, there might be somebody that's willing to buy it from you, but they're probably going to buy at a discount because they know that you need that liquidity and want to do that. I think that's a very, very important lesson. And that's why, that's a liquidity premium that you're paying, when you put your money in these. You also mentioned something else, which I've heard this multiple times from investors. They say, Chris, I'm making 30% on my rental. And I said, okay, let's walk through that. I bought it for 200,000. I put 40,000 down. I'm making, 30% on my money, which would be what, 12,000 a year, $1,000 a month. That's a little bit more reasonable. But then you say, well, what's your management fee that you're paying? Oh, I manage it myself, as you were saying. It's like, okay, so that's 10%. What are your reserves that you hold for turns, like you were saying? Oh, well, we don't have any vacancy because, what about maintenance? Oh, it's a new property. It's like, whoa. It's like, well, if you put that 25 or 30% aside, are you really making 30? You're making zero at that point. And I think that's what a lot of investors that have been active have seen is you have to compare apples to apples. So talk about how, you looked at that, you said, okay, I don't know if, like, for me, I looked at the returns I was making specifically on my equity as my properties had appreciated over time. And I was making like 7% before tax is what I realized. And I was like, geez, and that's what drove me originally towards multifamily and syndications. I more than doubled my returns with less work and better tax advantages. Did you see something similar?
Absolutely. I think the key, there's a few key points here. And, one of them is when you're just an active investor, you're probably not behaving like a professional asset manager, right? So I did, vacancy, right? When I was doing my report or my pro formas, I would count 5% for vacancy.
Mm-hmm.
Okay, but that's all in. Vacancy includes a lot more things than people just not being in the apartment, right? That
Yeah.
vacancy has like four different metrics: loss to lease. There's all these different parts of vacancy that, as an
Yeah.
active investor, I didn't even know about. So real
Yeah.
vacancy on a on an apartment, they're going to have 5% for actual vacancy, and then all this other stuff. So it ends up being 10 or 8 or whatever.
Yeah.
So
Your
there's
true
factors.
economic vacancy. Yeah.
Yeah, that's what I
Yeah.
was looking for. Economic
Yeah.
vacancy is different than vacancy, but I
Mhm.
didn't know that until I got into commercial real estate. But when you look at the returns of active versus passive, for
Yeah.
me, the only real way I can see someone being active and beating the returns of a passive investor are if you have certain skills. Like, let's say
Mm.
you're really good at swinging a hammer and doing rehab and you want to do it
Yeah.
yourself.
Yeah.
Great, you have an advantage. Or let's say you know the Columbus market better than anyone. So you know
Yep.
exactly what submarket to buy properties in. You have a huge advantage. Okay, you can win there. But
Yeah.
other than kind of those kind of advantages, if you're just a regular guy like I was and
Yeah.
still am, I didn't have any of those advantages.
Yeah.
So why wouldn't I? The same as I'm hiring a CPA to do my taxes and an attorney to write my legal documents. Why don't I hire an asset manager to manage my real estate assets?
Yeah.
Because they're going to do it better because that is all they do, right?
Yeah.
I'm just some guy who's listened to Bigger Pockets podcasts and I had some success, and you can have success that way.
Yeah.
But if you have capital, right? If you're later in your career and you have access to capital, why don't you give it to a professional to manage? It's the
Yeah.
same way when I was, 30 years old and kind of scraping by, I could maybe write out a contract on my own. I did my taxes on TurboTax. But now
Yeah.
that I'm in my mid 50s and everything's a lot more complicated, I have a little bit more money. I pay people to do that because
Yeah.
I get better results. It's the
Yes.
exact same for an asset manager to pay someone to manage the real estate who is a professional. They're going to do it better than me. And the returns have shown I'm going to get better returns. Now, when I was an active investor, I got super lucky because the market went up for 10 years, right? I mean, it was just
Oh
incredible.
yeah, cap
So,
rates were compressing.
right,
Money was free essentially. Actually,
right,
negative real interest rates. It was incredible.
right. So
Yeah.
anybody could make money those days
Yeah.
investing in real estate. And I did, but almost none of my properties cash flowed. And the
Yeah.
funny thing, when I did the analysis to purchase each and every one of those properties, I got an Excel spreadsheet and I did a cash flow analysis. This property is going to cash flow X amount and this is going to be the cash on cash return. None of that happened.
Huh.
The only thing I
Yeah.
didn't
Yeah.
model was what the appreciation would be. And that's where I
And that
doubled
did
my money
happen.
on a lot of these
Yeah.
properties was appreciation. The one thing I
Yeah.
didn't pay much attention to, didn't model, that's where I had success. And so you have a lot of operators out
Interesting.
there
Yeah.
now who are saying, well, look at all the success I had. And I'm like, yeah, you had the same success I did, right?
Yeah.
Which was the market, appreciated. So
Yeah.
now that we've been through some troubled times,
Yeah.
fortunately I sold before then, we're going to be able to evaluate operators based on the good and the bad. It was really hard to evaluate an operator in 2019. They say, hey,
Yes.
I've been doing this for 6 years. I've never lost investor capital. Well, I hope not, right? Nobody lost anything those years. But
Yeah.
now, okay, did you lose investor capital? And they say yes. That's not a disqualifier, but it means I'm going to ask a lot more questions. Where in
Yeah.
2019, I would have been like, no way. How could
Right.
you lose capital? Right.
Yeah.
So it's changed
Yeah.
a lot. And I think it's made it easier in some sense to evaluate operators because we've been through these challenging times.
Yeah, that's a great point. And, I think a lot of people, I've talked multiple times seeing real estate cycles since I was younger. I watched both my parents lose their jobs in real estate, the savings and loan crisis. I watched,
Mm.
9/11. That was kind of a part of the cycle that went down. 08, 09 was obviously, just massively destructive to real estate in general. I think we're coming up to another point where we're going to see, a shakeout occur, which we're seeing that right now.
Yeah.
Jim, what are you seeing, in terms of operators coming? We'll kind of do some fun like speculation here.
Yeah.
What do you see are going to be the sectors that are going to outperform for LP investors? And we can also kind of transition and kind of some of your thoughts with the new administration, the Trump administration coming in, and how that's going to affect some of these real estate investments as well.
Yeah, I think the next few years could be really good for multifamily. I think
Yep.
it's going to have to clear out a lot of stuff over the
Yeah.
next 6 months to a year.
Yeah.
But it's just if you look to and I think a lot has been made about this, but there's so many new apartments delivered in the last couple of years, and
Yes.
there's none being started now, which means
It's
there will
like
be
it's dropping off
almost
a cliff. Yeah,
right,
it's it's
which
it's
means
almost incredible how far it's going to drop. Yeah.
and in 2 or 3 years, that's when we're going to need that supply, and it's not going to be there. So I think
Yeah.
apartments are probably going to be good then. I think
Yeah.
industrial probably will still keep going.
Yeah.
Maybe not as good as it has been, but I think it'll keep going. And I think if you're in the right place for office, I think there's some opportunity there. And
Yeah.
I think neighborhood retail is pretty popular, and I think that could continue.
Yeah.
I think the as far as the next 6 months to 2 years, um, it's just so uncertain, right?
Yeah.
I think the beige report, which I guess is what the Fed
Mhm.
comes out, or
Yeah.
one of the Feds comes out
Beige
with
book. Yeah.
every, that's what beige book comes out. I think 6 times a year, but they broke the record this time that it just came out for using the word uncertainty. It was used
Oh,
over
interesting.
45 times,
Yeah.
and it's because we have tariffs on, tariffs off, tariffs on, tariffs off, and so no one knows what's happening, right? Immigration is another big one that no
Yeah.
one knows what's actually going to happen. So I think
Yeah.
part of the thing with this new administration coming in is everything is so uncertain, and
Hmm.
they used
Markets
to,
don't like uncertainty. Yeah.
yeah, and politicians used to get in trouble for waffling, right? But it's like, I don't know if waffle is the right word, but it's just so back and forth. Like, yes, we're
Yeah.
going to do this. No, we're not. So no one knows what's going to happen. And I think that just has everybody kind of spooked. And so people can't plan. If you don't know what's
Yeah.
going to happen, you can't plan. So
Yeah.
I think the next, until we kind of get some certainty, I think it's just going to be a roller coaster.
Yeah.
But in the long term, real estate performs, right?
Yeah.
Just listening to
Hmm.
John Chang on a podcast
Yeah.
yesterday,
Yeah. I love John. Yeah.
and he was saying, 2020 to 2025 was a 5 year period. And if you look at that 5 year period, you probably did okay if you were consistently
Hmm.
in real estate. Now, if you're
Hmm.
going to look at 21 to 26 or 22 to 27, I don't know if that's going to be the same thing. But what Brian
Yeah.
Burke says, who's also an experienced real estate,
Hmm.
he says over any 10-year period, real estate's going to do fine, right?
Yeah.
And that's not necessarily the same as other asset classes. The stock
Right.
market and other things might
Yeah.
not be like that. But
Yeah.
real estate is pretty predictable,
Yeah.
and it's never going out of style, right? We're always going to need
Yeah.
a place to live. So I'm
Yeah.
I'm bullish on real estate, and I have a few asset classes I'm looking at. But really, the nice thing is you can pick it. It's hyper local, right? If you're
Yes.
investing in the stock
Absolutely. Yeah.
market and you invest in Apple, and Apple
Yeah.
has the best year ever, stock crash, Apple's price is going down, right?
Yep.
Where
Yep.
if you
Yeah.
invest in an apartment in Columbus, Ohio,
Yeah.
and something happens in North Carolina,
Yep.
your people are still going to pay rent in Columbus. So
That's
I
right.
think that's
Yeah.
the benefit of real estate.
Yeah, that's a great point. And the other thing is with the stock market is, we've seen this repeatedly. You can have a great stock, but if the entire market corrects, like it has 10% here, over the past few months, then everything goes down
Yeah.
effectively. As those, whether it's the P multiples that reset or whatever it might be. So it all kind of gets sucked down with it with those risk on assets. But it's a great point. And we've seen, one of our most popular offerings here the past couple of years has been our debt fund, because investors say, oh, we can put it in here, we can collect some income, we can pull it out if we want to, and we can kind of ride out some of this uncertainty. So we've seen a lot of popularity, and we've
Yeah.
also seen rates like go up like 50% for investors in some of these income producing assets,
Yeah.
whereas
And
the equity has kind of come down.
I should have mentioned debt,
Yeah,
because that is, that's the most
yeah,
popular
yeah,
offering that I see now. If you put
yeah,
a debt offering, and
yeah,
it's funny that that's the most popular when debt is
yeah,
what caused all the other deals that are going bad,
yeah,
right? Bad, and now people are flocking to debt. But I think
yeah.
it's a different kind of debt. You're on the
Yes,
other side, right? You're not on the equity
absolutely.
side. You're on,
Yeah,
so the debt is your friend. But
yeah,
that is super popular. And it'll be interesting to see over the next few years as hopefully these equity deals come back and are able to be profitable again if the interest in debt decreases. But right
yeah,
now, probably over the last year or 18 months, I'd put more money into debt than I have probably into equity
yeah,
offerings. So that's a great
yeah.
point.
Yeah, and I've talked a lot about, we kind of mentioned the real estate cycle, and I think it goes in like 18 and a half year periods.
Yeah.
And right now where we are, banks are profitable. And like you were saying, be on the other side, be the bank. Being part of that debt is being the bank. So when bank profits go up as interest rates go up, investors can take part in that. So if you're listening, you want to learn about that, click on our invest link and you can get more information about some of the things we do. But Jim, I'm excited. We were talking about your Passive Pockets Summit coming up here next month. Share a little bit about that with the audience and how they can learn more about not only Passive Pockets, but also your summit here in the near future.
Yeah, we used to do a meetup at Left Field Investors, and it was by far the most popular thing that we've done. And I don't want to boast, but there were some very experienced people in real estate who came to a couple of our meetups and said they hadn't been to a better meetup. And awesome. We're going to do the same thing with the Passive Pocket Summit. It's May 2nd and 3rd in Columbus, Ohio, and we have just some great guests: Brian Burke, Jeremy Roll, plenty of others.
Great guys,
and it's what we try to focus on is networking, putting people together. So if you're an LP, you're going to go there and you're going to meet a ton of LPs. There's going to be opportunities for you to meet people and come out with long-term relationships. And the same with GPs. You're going to be able to meet all the GPs that are there as well. When I went to the big thing I've gotten ever out of a meetup was when I went to one and I met a guy, Ryan Stieg, who became one of the LFI founders. But he and I just kind of connected at a meetup, decided we were going to have our own little 2-person mastermind and have a conversation once every 2 weeks just to share ideas. And we did that, and we've become great friends. And so that's what you're looking for at these meetups, these resources that you can use, people and otherwise. And so we're really excited to have our first Passive Pockets Summit. You can check it out at passivepockets.com. There's an event tab, and just click on that. And then also, if you want to go to passivepockets.com, you can get a free 7-day trial to our community. You can access the forum, the operator reviews, all of the content that we have. We do deal reviews where you can see experienced LPs asking tough questions of operators. There's just a ton of content there. And this is kind of, I know I'm pitching Passive Pockets, but the real pitch to me is if you are going to be a successful limited partner investor and you're going to invest in syndications, the number one factor in your success is going to be if you join a community. Now, I recommend that the culture of that community matches your personality. And if Passive Pockets isn't it, I'm biased, I think it's great. But if it's not for you, find another community. There's a lot of communities out there. And you mentioned your own community, right? You're giving away resources and things like that. So you need these communities so that you can learn to become a better investor. So I can't recommend enough joining a community.
Absolutely. No, we're big on that, Jim. And if you want to learn more about ours, you can check everything out at nextlevelincome.com. Also check out passivepockets.com to learn more about Jim's community. And Jim, always enjoy our conversations here. Great to see you again.
Thanks for having me, Chris. It was a pleasure.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.